Hello friends, I welcome all of you to joining me in this session. So today we are going to discuss a very important Ind AS of Ind AS series, that is Ind AS 101 first time adaptations of the Indian accounting standard. So I plan to decide this Ind AS into three parts. In first part we will discuss about some basic points like what is the Ind AS 101, what is its objective, what is its applicability, and a summary wide discussion about the exemption and the exceptions, then the disclosure requirement and the presentation. So this we will discuss in the our part 1. Part 2 we will discuss about the assumptions. There are around 13 assumptions which are applicable in Ind AS from the other Ind AS. Then in third part we will discuss about the prohibitions of the retrospective applications of other from the other Ind ASs, as well as few important points which we will discuss in topic 3 to complete summary of Ind AS 101. So guys, I welcome all of you. Those who joining me first time, warm welcome to them and my all respective viewers. So let's start without wasting any time. So as I discussed earlier guys, so I have divided this session into 4 different sections. First section we will discuss about the introduction. Here we will discuss about why this first time adaptation of Ind AS come into existence, what is its objective, and we will discuss about the few definition which is important to understand the concept of Ind AS 101. In second section, applicability, here we will discuss about on which entity it is applicable, on what are those entity for which it is not applicable. Then third section we will discuss about the recognition measurement criteria. So here we will discuss about exceptions, assumptions of the few Ind AS in respect of Ind AS 101, and in last we will discuss about the disclosure requirement in financial statement. So here we will discuss about what type of reconciliation we have to prepare and how many financial statement we have to prepare at the time of first time adaptations. So these are the 4 sections we will discuss. Topic number 1, introduction. So guys, Ind AS 101 is apply for those entities who are preparing their financial statement first time. Means till last previous year they are preparing their financial statement as per either a company accounting standard rule 2006 or banking regulation act or insurance act, as the specific rules are applicable for those entities or corporations. Okay, now they from the year in which they are going to apply the Ind AS, they meet the eligibility criteria to prepare their financial statement as per Ind AS. So there are 3 and 4 criteria. Like for a listed company, they have, if it is a listed company, they have to, if their net worth is more than 500 crore. Unlisted company, they have a net worth 250 crores. So there's so many criteria we discussed in framework of the Ind AS or basics of the Ind AS chapter. Okay, then once the company are going to apply Ind AS to prepare their first financial statements, so they have to follow all the rules which is applicable based on the Ind AS criteria, and these Ind AS will be effective from the reporting date for its first financial statement. So there is a 2 type of date. First is reporting date, that is basically the last day of the year, and date of transition, which is the first date, earliest period date, which is used to prepare the opening balance sheets. Okay, while preparing the opening balance sheets, they have to perform few activities. What are those activities? So first of all, they have to recognize all the assets and the liabilities as per the recognition criteria defined in Ind AS. Means first of all they have to restate their balance sheet, opening balance sheet at the date of transition date. Then reclassify it means, and second they have to non-recognize those assets as well as the liability which does not permit it or which does not recognize as per the Ind AS. Okay, in third point, reclassify item that was recognized in the previous gap. It means that suppose the company has some type of asset which are considered as a current assets as per the previous gap, but for Ind AS this should be part of the long-term assets or non-current assets, so they have to reclassify the assets as well as the liability sections. In the last, they have to, after recognition criteria, recognize all the assets and the liabilities, they have to apply the measurement rules. Measurement rules means for all recognized assets as well as the liability, they have to do the measurement of all these assets, either maybe in fair value, for cost model, or so many models are there. Basically all the Ind AS are roaming around the fair value concept. Okay, so these things we have to keep in mind while we are going to apply the Ind AS 101 and preparing their first financial statement as per the Ind AS. Topic number 1.1, second part of introduction. So guys, sometimes entity feels that to implement the Ind AS, the cost is higher as compared to the benefit they will receive by implementation in Ind AS. For that purpose, they will exempt Ind AS 101 exempt those entity to apply the requirement for specified areas. There are 13 specified areas we will discuss in the part 2 and part 3. Okay, then sometimes based on the past experience of the management during the operations of the entity, they feel that there are some condition which is not allowed to company to follow the principles retrospectively of Ind AS. So that purpose there are 7 or 8 types area we will discuss. So if they have a conditions which are come under those areas, so they will not apply this Ind AS retrospectively, they will follow that principle prospectively. We will discuss. Then in third point, it is necessary to explain, to disclose by the entity that what are the effect on their financial positions, their financial performance and the cash flow on the entity by conversion of the previous gap into Ind AS IFRS for the users. Okay, so if we say that the main purpose to introduce objective of the Ind AS 101 is that first of all it gives the transparency to the users, and it will help to the users that such Ind AS financial statements give high quality informations compared to all over the period, and also they can achieve the information at the cost which is below the benefit received from that financial statement. This is the only objective of Ind AS 101, because Ind AS give detailed information to the user. The principle of Ind AS are so wide that each and every Ind AS give detailed disclosure in very wide manner. Topic number 3, 1.2 important definition. This is the part of introduction. So as I discussed that what is the date of transition, this is the starting point of the earliest period for which entity can present full comparative of the information. Suppose you are going to prepare your financial statement for period 2019-20, so date of transition shall be the 1st of April 2018. Okay, so we have to think about it. So for first opening balance sheet is 1st April 2018, then comparative 1st April 2018 to 2019, and then 2019 to 2020 is our present first financial statement. Okay, fair value very important, because you will see when we are going further that what is the role of fair value. So here it is necessary to discuss. So fair value is the amount at which assets could be exchanged, liability could be settled between the independent, knowledgeable and billing parties. These three component related parties important: independent, knowledgeable and the billing party. First, Ind AS statement and reporting period. So first Ind AS statement for which entity apply Ind AS. Okay, it is a particular whole period, and the reporting period is a date means ending closing of the year. Most probably 95%, 99%, that is 31st March of any year. Then opening Ind AS balance sheets means the balance sheet prepared at the date of transitions. Okay, deemed cost. Yes, this is very important. What is the deemed cost? So deemed cost is the cost amount which is initially considered as a cost to measure the depreciation or the amortizations. So for few items deemed cost is different. So this we will discuss in part 3, like for all explorations and property, plant and equipment. So in wider manner we can say the amount used for the cost and depreciated cost at a given date, okay, for which subsequent depreciation and the amortizations can be charged by assuming that at the date of transaction whatever the value we have decided to be considered as a deemed cost, it shall be as a deemed cost. Okay. Topic number 2, applicability. I divided into two parts. First part we will discuss about the applicability, second part we will discuss about non-applicability. So in first part, so it is applicable for those undertaking which are preparing their financial statement first time as per Ind AS. Okay, either they come into a existence first time or they meet the criteria to implement the Ind AS for those entities. Then they also include the interim financial report for those period which is cover under the first time adaptation of Ind AS. Okay, this is the basic requirement. Now there are few others. What are those? So the undertaking which are presented their previous financial statement as per the government requirement, but the these financial statement does not follow the full requirement of Ind AS. Number 1, they prepare their they follow the principle of Ind AS, but these financial statement does not give a complete picture, or you can say explicit and unreserved statement to comply the Ind AS. So what is this means, explicit and unreserved statement? It means that the whatever the Ind AS notified and issued by the Institute of Chartered Account of India, it is should be followed by each and every entities. They did not follow it. Okay, then company, it is applicable for those entities who prepare their financial statement as per Ind AS but for internal use only. They prepare their financial statement for consolidation purpose, okay, without preparing the complete set of financial statement. Complete set of finances divided into balance sheet, P&L, change in equity, other comprehensive income, cash flow, notes of account. Okay, then they did not present financial statement for previous periods. So this is applicable for those entities, Ind AS 101. Now come under the Ind AS 101. For those entities it does not apply. So it is not apply means those entities who prepare their previous financial statement as per Ind AS. Simple manner. If entity prepare their financial statement previously as per Ind AS, so they did not need to apply Ind AS 101. Okay, then they presented their financial statement in previous year under the national requirement, and these financial statement contain explicit and unreserved statement, means they have to follow all the principles, rules, regulation defined in Ind AS issued by the ICAI. Okay, they don't need to comply the Ind AS 101. Okay, and then last, that previous financial statement prepared completely as per Ind AS by complying all the rules. So this is applicability. Topic number 3, recognition and measurement concept. So first of all, a company who is going to apply the Ind AS 101, it has to prepare the opening balance sheet at the date of transitions. Whatever the accounting policies follow at the time to prepare the opening balance sheet, they have to follow same accounting policies to prepare the first time adaptation of IFRS financial statements, okay, for whole period. Then sometime it's happen the few new Ind AS is not mandatory for the entity to apply, but yes, they can follow it if it is permit early applications. Okay, sometimes it's happen that the accounting policy uses to prepare the opening balance sheet may be differ as compared to the previous gap on the same date. For those adjustment, for this type of differences is considered as an adjustment, and these adjustment will be set off with the retained earnings. Okay, at the date of transitions. Then sometimes if entities have as I told you earlier, that sometimes it's happened that company is not able to implement the IFRS because the cost to implement these IFRS is more than the benefit they will achieve. For that purpose, they will follow the exemptions and the exceptions in the opening balance sheet of Ind AS financial statements. Okay, so these things we have to keep in mind. Topic number 3 point from recognition measurement part 2. Here I only give you the summary. The discussion, the detailed discussion we will for exemptions to use principle of other Ind AS I will give into the part 2, and the prohibition retrospective application in part 3 will going to be released soon. So these are the 13 type of criteria. Here I have mentioned 11. So what is this? Business combinations related, fair value or revaluation as a deemed cost, staff benefit, lease is a separate, and insurance contract is separate exemptions. Cumulative CTA, which are cumulative translation adjustment, essential liability, joint venture subsidiaries, compound financial statement, share based payment, designation, privileging of financial statement. These are so much, but we will discuss in detail. Same thing for retrospective application prohibitions, derecognition of financial assets and liability, embedded derivatives, hedging, estimates, assets held for sale, discontinued operation, non-controlling interest means minority interest, and the government loans. So these things basically, this is a summary we have to keep in mind if we are going to apply Ind AS 101. What should be the treatment we will discuss in second and third part. Topic number 4, presentation and disclosure requirement. So first and the foremost disclosure requirement, they have to prepare at least for 1 year comparative information for first Ind AS financial statement. There should be 3 balance sheet, opening balance sheet, comparative, and then present, 2 profit and loss account, comparative and present, 2 statement of cash flow, present and comparative, previous year, 2 statement of change in equity, previous year and presented, and related notes of account. Okay, they have to follow the exemptions to restate the comparative information. Ind AS 39 financial instrument related, Ind AS 104 if there is any insurance contract. Okay, for deemed cost requirement, there are some they have to give disclosure of the those items like PP&E, intangible investment property, for which deemed cost is applicable. So in first Ind AS financial statement, what are those disclosures? Aggregate value of the all line items, means aggregate fair value of all items, investment property, PP&E, and intangible assets. Also they have to disclose the in aggregate all the adjustment they have made in their carrying amount as per the previous GAAP. Okay, so this is a disclosure they have to giving. Although there is not a specific requirement for the disclosure, means Ind AS 101 does not provide any exemption from the presentation and disclosure requirement as defined under other IFRS. Okay. .1 presentation and disclosure requirement part 2. So here I will mention 3 different categories. First of all, designation of financial assets or financial liabilities. So undertaking has to disclose the fair value of the financial assets or the financial liability which is designated into the each category at the date of designation. So for financial assets there are the 4 categories. For financial liability there are the 2 categories. Just example, held to maturity, available for sale, fair value through profit and loss accounts, and loan and the receivable, it is related to the financial assets. These are 4 categories. For financial liability, amortized cost and fair value through profit and loss accounts. So they have to give these criteria, classification they have to make. Then they have to make the disclose the carrying amount of the financial asset as well as the financial liability in respect of their previous financial statement as well. Okay. Now the for historical information disclosure, although the Ind AS 101 does not require such type of summary which compile the recognition measurement requirement of IFRS, but some entities give this historical summary of comparative information. For that purpose, entity has to especially define those previous GAAP information which are not prepared as per the IFRS, and also they have to disclose the nature of the main adjustment that would make to comply with the IFRS. Okay, so these things they have to disclose if they are giving the historical summary of the previous period. Then explanation of transitions, so they have to disclose that how the transition from the previous GAAP to IFRS affect the reporting financial positions, financial performance and the cash flow of the entities, and it is necessary for Ind AS for financial statement as well as the interim financial reporting as well. They are required to disclose about what is the most recent information published under the previous GAAP, that user need to be up to date about these informations, and then they have to give the information at the date of transition into IFRS. So these things they have to comply with for the disclosure perspectives. So guys, topic number 4.2, presentation disclosure requirement part 3, reconciliation statement. So the entity who is preparing their financial statement first time as per Ind AS, so they have to prepare the reconciliation statement, in which they have to show that what is their opening balance sheet balance of the equity, and what is the addition, what is the deletion, what are the adjustments they have made during the year due to change in the previous GAAP to the Ind AS, and they come into the figure which is shown in the first Ind AS financial statement. Same thing they have to follow for the profit and loss account, but the period would be same. Okay, if there are any differences arises due to conversion of previous financial statement as per previous GAAP to the Ind AS, so they have to adjust it with the total comprehensive income, but this is applicable for the reconciliation perspective. Okay, then if there are any impairment losses they have made at the date of transitions, so entity has to recognize those impairment losses and reversal thereof which is related to the period beginning with the date of transitions. Okay, so they have to make the disclosure of the impairment losses. Second thing, if there is any adjustment, means if you can say that if undertaking presented their cash flow statement as per the previous GAAP, so it has also explained the material adjustment into their cash flow which is prepared for as per Ind AS 101 and 107. Okay, then if in last financial period company or management has aware of and some type of errors as per the which is related to the previous GAAP, so while preparing the reconciliations they have to distinguish these corrections of those error in respect of the change in the accounting policies. Means if there in reconciliation there are some changes made due to change in accounting policy, so if any changes which is happened due to the correction of errors, so they have to shown separately. So these things keep in mind. Okay, so this is our 4.2 topic. So thank you guys, this is all about Ind AS 101. I hope you enjoy the session, and apology for the same if something is missing and I could not give you in detail any information for that. If you have anything at your side which you are not able to understand in this session, so you may send me the mail on my mail ID which I have given on the last slide, and we will come again with the part 2 of Ind AS 101. Till then, good for now. Thank you so much guys. Bye.